And then you start to see things like you know, uh, the CIO of Morgan Stanley saying, well, maybe a 60-40 stock to bond allocation isn't really good. Maybe we should go 60-20-20, 60% stock, 20 bond, 20 gold. You have Jeffries, one of the head traders at Jeffries, saying now 6,600 is what they're expecting. You have Michael Hartnett from Bank of America said, well, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. You have Goldman Sachs saying if the Federal Reserve gets one whiff of the uh, Federal Reserve losing independence, Goldman Sachs says this, but what's Stephen Mirren, who filled that vacated spot, but the author of the Mar-a-Lago Accord and advisor to Trump? What independence? So there's a lot of, I think, signals pointing to the very, very big money, the institutional money.
What if I informed you that the London Bullion Market Association, the foundation of the global gold and silver trade, is in danger of experiencing systemic failure in the next day? Andy Schectman, a prominent figure in the precious metals sector, cautions that the decades-long Western price suppression is finally unraveling. In the event that the dam ruptures, the price of silver could soar beyond $50 and proceed directly to $100, $150, or even $200 per ounce. For years, investors have been advised to disregard gold and silver. However, the United States is currently importing a greater quantity of gold than it has at any point since World War II. Washington has reclassified silver as a critical mineral, and central banks worldwide, including those in China and the BRICS nations, are discreetly depleting the supply. What will transpire when the West ultimately relinquishes its authority over price discovery? The response has the potential to permanently alter the financial system.
Several months to fire hose type of volume, there's an awakening. And maybe it has something to do with all the metal that's been imported into the COMEX over the last 9 months, levels that we've never seen before, anyone has ever seen before. And that goes hand in hand with what we've been talking about for a long time with the central bank buying. And then you start to see things like you know, the CIO of Morgan Stanley saying, well, maybe a 60-40 stock to bond allocation isn't really good. Maybe we should go 60-20-20, 60% stock, 20 bond, 20 gold. You have Jeffries, one of the head traders at Jeffries, saying now 6,600 is what they're expecting. You have Michael Hartnett from Bank of America said, well, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. You have Goldman Sachs saying if the Federal Reserve gets one whiff of the Federal Reserve losing independence, Goldman Sachs says this, but what's Stephen Mirren, who filled that vacated spot, but the author of the Mar-a-Lago Accord and advisor to Trump? What independence? So there's a lot of, I think, signals pointing to the very, very big money, the institutional money, is moving in this direction. Jeffrey Gundlach, the bond king, comes out and says 25% gold is not too much of an allocation. Now, my whole career, Kai, 5% was acquiesced by the financial advisors to appease their clients who were into gold. 25%, when the biggest money in the world, from Tether to the commercial banks, to the central banks, to the bond king, saying, look, we made our mark in traditional assets, but you might want to weigh up your gold allocation. Something's different, honest to God. And then you add on all the imports into COMEX, which is 5 feet of snow in Death Valley in July in terms of an anomaly. Every month, billion over billion over billion over billion in gold and silver coming into COMEX. Something is really very different. For the very first time in 35 years, I mean that sincerely. Something's very different. There has been, to your point, there has been a tipping point. What tipped it, I'm not sure. Maybe it was the little by little that's just starting to tip the, they have those things on the cruise ships. They fill up with water and then it finally tips over and it pours down on the, on the slide for all the kids. That's what it's like. It's like it's like something is tipping. I don't know. I think it's just a realization that the Federal Reserve is going to move to cut rates. Cut rates in an environment raising a rising inflationary environment where the CPI has stayed above their target 2% for over 53 straight months, where they've revised, you're going to talk about the unemployment numbers, they've revised almost 500,000 jobs year to date as is, let alone all the revisions that we saw before that. And so I think that it's a weak market. It's the realization that we have chosen inflation over austerity and getting our balance sheet in order. And maybe the world is finally waking up to that holding treasuries. When Jeffrey Gundlach, the bond king, says, let's just, all of these guys, whether it be Morgan Stanley, Goldman Sachs, Jeffries, or Jeffrey Gundlach, saying, we're going to take money off the bond table and reallocate it to gold. That's when people should stand up and take note. This is how these people made their mark, and now they're backing away from it. I don't know. I think maybe that is the tipping point, is that they're speaking to institutional level people. They're not speaking to mom and pa. They're speaking to their institutional clients. And, Michael Hartnett's letter is not cheap, and the analyst for B of A, and to go to 25, 25, 25, 25, who's ever heard of that until now? Understand this. You will more than most. It's a heavy responsibility to do what we do, and you can get out here and say what you believe, but you're putting your name and your reputation on the line in front of the world, and people follow what you're saying. I feel relieved that the amount of time that I put in, and just like I'm sure you do, 3, 4, 5 hours a day, 7 days a week, researching, studying, mostly reading, not watching podcasts, scouring the globe for information. I'm happy to know that it's helped some people and that it's coming true. And quite honestly, it's more concerning and frightening than anything. Yes, there is reason to be optimistic. It's the Shawshank Redemption. It's crawling Andy Dufresne, crawling through the tube of crap for 2 miles to get to the other side. And there is reason to be optimistic in much of what I see and much of what Trump is trying to do to reshore manufacturing. But if you're not paying attention to what is happening and how they're going to get there, in particular with the Genius Act and my belief of pegging gold to the back end of the bond market, as Judy Shelton has talked about, if you're not paying attention to what that looks like in the mechanics, saving in dollars, you're destined to go broke. This is the first time in my career where I truly do believe that if you're not a contrarian, you'll end up being a victim. So yeah, I guess you could say, relieved more than I am feeling vindicated. I always in my soul knew that I was right. At least I felt I was.
It feels good, to be quite honest. Coming out of a 14-year bear market in the mining stocks as well, it feels good to finally be right. I hope I'm not just a broken clock who's right twice a week or twice a day, right?
Dude, you know what? You can be right based upon economics and logic and be wrong for a long time, because people that have been using suppression to hold down these markets, these are very powerful folks who have now gone the other way, and they're like, no, I think we're going to go long and stand for delivery. There are different things happening, different dynamics, I believe, that will make you look right in spades before it's all said and done.
The current configuration of silver is unprecedented in the past few decades. Andy Schectman emphasizes the 45-year cup and handle configuration, which is considered one of the most robust technical patterns in history. Silver momentarily approached the $50 level in previous cycles, such as 1979 to 80 and 2010 to 11, before surging upward. According to analyst Michael Oliver, the direct trajectory of silver toward $96 per ounce could be initiated by breaking through $50 today, with momentum propelling it significantly higher. However, this is not solely about statistics. Schectman emphasizes that Western central banks utilized paper contracts to suppress the prices of gold and silver for decades. While the world was compliant, that system functioned effectively. However, the BRICS nations, China, and even Western insiders are now advocating for physical delivery. The London Bullion Market Association, which is the site of the world's largest bullion exchange, currently maintains an inventory of platinum and silver that is less than 1 day's worth. Some of Europe's largest banks may be at risk due to a chain reaction of default that could be initiated by a single sizable delivery request. Concurrently, the United States economy is descending into stagflation, which is characterized by a combination of increasing inflation and a slowdown in growth. The Federal Reserve is ensnared. Inflation is at risk when rates are reduced, while a collapse in the treasury markets and employment is at risk when rates are raised. Concurrently, Washington is issuing nearly $1 trillion in new debt every 100 days, which is undermining its credibility. The dollar has already experienced a decline of over 11% this year, resulting in negative real returns for Treasury investors. Big money recognizes this and is transitioning from U.S. debt to commodities. The sharpest traders were positioned early, as gold and silver have already returned over 50% year to date. Schectman's counsel is unambiguous. Avoid accumulating funds in dollars. When your government publicly discusses the devaluation of the dollar in order to relocate manufacturing, cash is a vulnerable asset. The sole defense is assets. His primary recommendations are gold, silver, and platinum. He identifies silver as asymmetrical, characterized by a tremendous upside and a restricted decline. Additionally, the indicators are ubiquitous. For the first time since World War II, the United States has discreetly become a net importer of gold, with a total of over $150 billion in gold flowing in since November of last year. A significant portion of this accumulation is not subject to IMF reporting, as it is not reported through sovereign wealth funds, proxy banks, or concentrates that do not generate official data. Schectman is of the opinion that the U.S. Treasury may employ covert channels to replenish reserves in anticipation of a monetary reset. Gold is being reintegrated into financial systems on a global scale. From the digital yuan of China to the Shanghai Metals Exchange's gold convertibility and Saudi Arabia's construction of new gold facilities under the Belt and Road initiatives. In the United States, the reclassification of silver as a critical mineral is an official recognition that it is not merely a precious metal. It is indispensable to both national security and industry. For the first time in decades, policy factors and market momentum are aligned. Increased prices for precious metals.
There's no question that it's still the continued, the continued main characters, China and the BRICS nations. But what's vastly different, is you have the most well-informed traders here in the West, in the United States, that are standing for delivery to the tune of billions and billions and billions and billions every month. And the question that you ask is one that should really be thought about. Who the hell is buying all of this? Every month we're seeing billions and billions and billions every week come into the COMEX. And, guys like Vince Lancy, who are no dummies, and he's a smart dude, one of the smartest in the industry. And he says, look, 85% of the gold that's being bought by the central banks is not being reported to the IMF. They're bringing it in ways like China going in and buying doré and concentrate, as Sean Kunkun will tell you from Dolly Varden, from all of the miners in Latin America and in Mexico, pulling gold and silver out of the ground before you even call it that, because it's in concentrate and doré form, shipping it back and refining it themselves. Well, that doesn't trigger IMF reporting. It's under 999 fine. Or buying it from other locations around the globe through maybe proxy banks or sovereign wealth funds that don't trigger it, and using artisanal and local miners, and bringing it in not through the central bank channels, so it's not reported. All I'm saying is that the biggest money in the world has been doing this for a long time and getting more creative in the way they're doing it. But what is different now is that who the hell is bringing it into this country? If I had to guess, now again, could be a guess, I would say it's the Treasury Department under the guise of the Exchange Stabilization Fund, where it can be quiet. Don't tell anyone, it's for national security. And now I think you should interview Tom Luongo as well. He has a very interesting take, and that is that Trump understands or believes that it is the European aristocrats who were behind any perception of election interference and a color revolution in this country during the previous administration. And he's out to get the Bank of England and those banks who are massively short in London. Now, all the gold that's been coming back, could it be that it's been covering the short positions of the banks here in the States who, when they short on COMEX, they go long in London, they bring it back, they call it tariffs. It's not tariffs. It's never been about tariffs. It's been about reshoring. So maybe if you want to walk that fine line of conspiracy and reality, and this is coming more from Tom than it is from me, but I think it's a very intriguing idea, is that all that gold coming back, maybe it's being used to cover the short positions of the banks in the States with the idea that it's going to go to the Treasury in terms of their gold acquisition for whatever their plans are with gold revaluation or pegging it to the bond market, as I believe, and to cover their balance sheet. And we're this close away to some sort of a systemic moment in London where the inventories, in particular of platinum and silver, are down to less than 1 day's worth of trading. And if these continued delivery requests happen, you're talking an existential threat for some of the biggest banks in Europe. And Trump is out to get them, is what Tom is saying, out to get the Bank of England and out to get these aristocrats that are the bankers in Europe by having some form of a delivery default in London that would very quickly trigger a systemic chain reaction that could bring down some of the biggest banks in Europe, as the banks in the United States have quietly covered. Now, could that happen? Don't know. All I'm telling you is the amount of gold coming into the COMEX every single week is unlike anything anyone has ever seen, and we are now net importers of gold for the first time really ever, other than World War II, when everyone sent us their gold as part of the World Reserve Standard. And, you know, since then, maybe 1 or 2 months here and there, but every other, the trend has been net exporters for the United States as far as gold is concerned. My whole career, which is going on 36 years.
No, it's interesting because I think it was in March or in April, I may stand corrected here, but the U.S. imported so much gold that it actually hurt the trade balance. Right. And Trump wanted to put on tariffs on gold imports from Switzerland. I remember that. So I was like, my follow-up question there to you, Andy, like, wouldn't that be showing up in the trade balance? I think we got numbers for August just recently as well. When it comes to those gold imports, wouldn't they be showing up there?
Well, some of it is, sure. Some of it is. And that's why I go back to what Vince is saying. How much of it is coming in ways that doesn't trigger it that way, using proxy banks, using sovereign wealth funds. And the interesting thing about it is that, you know, when you talk about the worthlessness of the mainstream media, who really hasn't done anything in this country but foment divisiveness, I mean, you would think that when the United States becomes a net importer of gold, going back to any time since World War II, where the amount coming in is that we know of north of 150 billion since November. And you know, there's a lot more than that coming in. But the questions aren't even being asked, who's doing this? And although obviously markets are meant to have anonymity attached to them, but where is really mainstream? Why is it that you have to hear from alternative media that this is going on, and what does it truly mean? I would guess that some of it has shown up. To your point, it did show up, but not all of it is being reported. If the idea was to use gold and reintegrate it into the monetary system, we're seeing it across the global south. We really are. We're seeing it massively being reintegrated into the plans, the settlement system of the Shanghai Metals Exchange, expanding their vaults throughout the whole Belt Road Initiative. The first one was built in Hong Kong. The next one is under construction in Saudi Arabia, so that they can trade their local currencies over the M-Bridge technology and settle imbalances like that in gold, where China has now, in an effort to internationalize the yuan and the Shanghai Metals Exchange, made digital yuan immediately convertible into gold, not converting back to dollars. This is going to be the rails of their payment system. I believe that gold will have a different role in the United States, but equally as compelling in terms of its monetary future. And any way you look at it, I just think that gold will be reintegrated into the monetary system. And the fact that the government just made silver a critical mineral here in the United States, we're seeing massive amounts of silver too, like literally billions and billions and billions and billions and billions every week coming in. And now it's a critical mineral. They just put a floor under the price as far as I'm concerned. Things are different, Kai. For the first time, the focus isn't on U.S. treasuries. In fact, the people who promoted it are saying maybe back off and buy gold. The focus isn't on these traditional assets that are now changing, and it just feels different at a level that would perpetuate legitimacy, that would accentuate legitimacy instead of fighting against the wind forever. It's like we got the wind at our back right now from the highest up of the food chain in terms of finances.
Therefore, what does this entail for you? It implies that your wealth is silently evaporating if you are sitting in currency. The currency is being intentionally devalued. Real returns on treasury bonds are currently negative. Additionally, the system that has been used to suppress the price of silver for decades is in the process of disintegrating. Andy Schectman's message is unambiguous. A delivery failure could occur at any time for the LBMA. History indicates that silver will not halt if it surpasses $50. It will reach triple digits before the majority of individuals are aware of the situation. It will already be too late by the time CNBC or CNN informs you that silver has reached $100. The inquiry is straightforward. Will you be situated prior to the headlines? Alternatively, will you be pursuing the transaction after it has already occurred? Protect your wealth with genuine currency, such as gold, silver, and platinum, before the system compels you to do so. These are no longer merely investments. They function as lifeboats during a tempest. If you found this analysis to be beneficial, please click the subscribe icon, enable notifications, and join us at Macro Edge as we monitor these historical shifts in real time. Precious metals will be the focal point of the forthcoming financial reform. Stay informed, be prepared, and never underestimate the speed at which the tide can turn.